Okay, now this one's seasonal. Do you guys know what seasonal means? Seasonal. Yeah, so some companies have seasonal cash flows, right? If you're, you know, a ski resort, right? A ski resort, obviously, when is their peak business going to be for a ski resort, right? It's going to be during the winter. So at that time, they're going to have more revenue at that time in that period of time, right? And then in the summer, they're going to be slower after that. Exactly, Wayo. It depends upon the season. Exactly. So we'll get into the examples here, you guys, and this will help you. Okay, the sales forecast again. So this is a prediction, and we can do this several different ways, right? We can use history, and this is where it's good to have a database, right? Database is a tool that collects historical information. So if we have all of our sales in this database, we can analyze that. We can do graphs, right? So we could have a graph that looks like this, right? We see the sales is going like that over time, right? And if we're trying to predict where we're going to be next year, right, at this point in time, probably up here seems reasonable. So that's one way to do it, is just, you know, extrapolating the past. Another way to do it is to ask the people, the salesmen themselves, right? Ask them, what do they want? What do they think is achievable? But we have to be careful there, right? Because the salesmen are going to get a bonus if they beat their sales targets, right? So they may try to game the system, right, by giving you lower numbers, right? And they know they can achieve more, but they give you this so that they hit their bonus faster. So you have to look at this too, to try to gauge what are they capable of, what did they do last year. But also it's good to listen to them as well, because they're the closest ones to the customer. So that's basically how we can do this, you guys. There's other ways to do it as well with regression models. Okay, so cash budgeting is going to help us with uncertainty, right? Uncertainty means there's risk. There's risk. And of course, what is the risk with respect to cash, you guys? What is the risk with respect to cash? What can happen, you guys? In terms of cash, what is our risk? The risk, of course, is that we run out of cash, right? So by making this plan for cash in advance, we can see if we're going to have trouble. We can also do scenarios, right? Which is what this is talking about here, scenarios. So scenario. So this one says pessimistic, realistic, optimistic. I usually use scenarios like this. Best, what is the best case? What is the expected case? What is the worst case? Right? So you can use this for all your budgets, including the sales, right? What's the highest sales I expect to get next year? What's the worst that could happen? Like coronavirus is probably among the worst situations that can happen to most businesses. And what do I generally expect is going to be here, right? So then by doing all the budgets this way, right, you'll end up with a cash budget as well that's best case, expected case, worst case. And worst case, if you're still okay cash-wise, then it means you can survive the coronavirus. If you didn't do this scenario analysis, right, you didn't do a worst case as bad as coronavirus, and then coronavirus hits, you might be out of business, right? Because it's really, really bad. And especially for some businesses that have to shut down, you know, this is terrible. And it's bad too, because people generally tend to be optimistic, overly optimistic and overly confident, right? So we're going to tend to underestimate the worst case, and we'll tend to overestimate the best case. So just keep that in mind when you're planning this stuff, that your best case is probably too high and your worst case is not bad enough, right? So make it worse than what you think is going to happen. to be on the safe side. Better safe than sorry. Now this is showing the format of a cash budget, you guys. So we're gonna have cash receipts. What is a cash receipt? What is a cash receipt? What is that, you guys? Cash receipts? Cash receipts is, yeah, let's see here. Yeah, exactly. Cash receipt is cash flow we get from selling stuff, right? So this is positive. This is the money that comes into us when we sell something for cash or when we collect it later from the customers. Then we have cash disbursements. What is a cash disbursement, you guys? What is a cash disbursement? Exactly. These are the expenses. We bought some capital, some machines, right? We paid the employees, we paid the electricity. And then we have our net cash flow for each month by subtracting them. So plus and minus gives you the net, right? This one is our starting cash, like your bank account, right? We have some cash in the bank account now, hopefully. So we're going to add these two together, right? To get to our ending cash. Beginning cash plus whatever happened in January is going to equal our ending cash down here, right? And then what we have here to be safe, we say let's keep a minimum balance in the bank, right? A minimum balance. So say a minimum balance of $100,000, something like that. So if this one is below our minimum balance, what we're going to do is we're going to take out a loan to cover the difference so that we always maintain the minimum balance. So what I suggest for most companies to do, if you can, is you have a line of credit. Line of credit. Like when I worked at the first bank I worked for, we had a line of credit for like $50 million, right? And so if we ever needed money, we just temporarily, even just for a day, right? It's in our bank accounts. We can shift money from the line of credit into the checking accounts immediately, right? So it covers us if we have any negatives over here, we can just borrow automatically from the line of credit so that we ride out the low times until we get back to the okay times. So if you had this big line of credit during coronavirus, you could be drawing on that, right, to pay your expenses until things come around. Okay, so let's just see if you guys have any comments on that. Okay, now let's do an example, and hopefully this will then make it set in for you guys. So I'll give you guys a second to read this first. Okay. So we're looking at Gulf Industries, you guys, right? And we're doing a cash budget for 3 months. October, November, December. Right? So that's easy, right? Then it says our sales, we're going to start off with sales. And again, this is just the information that we're going to use. Sales are 100,000 for August and September and 200,000 for the next month. Okay, then it says sales of 400,000, 300,000, 200,000 have been forecast for October, November, December. Now this is the key, and these are problems you guys will have on the test, right? So we give you something like this: 20% of the firm's sales have been for cash, right? And we're going to be doing a cash budget for October. So we said here October sales are 400,000, right? And if 20% of that is cash, how much of that will we collect, you guys, in October? How much of the 400,000 do we get in October if 20% of the 400,000 is cash? What's that going to be, you guys? Yeah, exactly, Mohammed. It's 80,000 is 20% of that, right? So, and then it says we're going to get another 50%, right, is going to be paid a month after that, right? Because not everybody pays us now. 50% of this number is going to come in a month later. So Of the 400,000, we collect 80 now. We collect another 50% of the 400,000 next month. So what's 50% of 400,000, you guys? What is that? What's 50% of 400,000? That one's easy. Yeah, 200,000. Good job, Mohammed. Okay. And then we collect the final 30%, right? 2 months after that. So we're going to have to plan for that. So for each month, we'll collect some in the first month, some next month, and the rest the month after that. So if you add up the numbers from the 3 months, it should equal 400,000. Then there's some other miscellaneous stuff like we receive a dividend from a stock that we own, right? So is this going to be positive or negative down here, you guys? Is that positive or negative, that dividend? What do you think, positive or negative? Yep, positive. Good job, Mohammed. And Gadir, very good. Gofran, you guys are on top of this. Excellent. Okay, so this is just information that we're going to use to construct this thing. So here it is, you guys. So we had the forecasted sales. These numbers were given to us before, right? It told us we had 400, 300, 200, and it told us some history here, right? So we just plug those in. That's the forecasted sales. Then we said cash is going to be 20% of this month's sales. So 20% of 100 is 20. 20% of 200 is 40, and so on and so forth. Does that one make sense, you guys? Right, some of these sales are in cash. We collect 20% of our sales in cash. The rest we're going to get later. So are you guys with me on that so far? That makes sense? Okay, so then we're going to collect 50% a month later, right? So for each of these cases, this 400,000 here, we collected 20% here, and we collect another 50% there, right? So this 100 is 50% of 200, right? This 150 is 50% of this one, right? Because we don't get all cash. It's not a cash business. We give credit to customers and let them pay us later. That's what that is. Then finally, it says some people take 2 months to pay us, right? They're a little bit slower. So this 30 here is going to be 30% of this number here, right? It's 2 months later, 2 months later, we collect 30% of this number. So notice here, the 100 for this one, right? Was 20, we collect it right away. Plus 50 we get next month. Plus 30 the month after that. That's the 100. So this is equal to that, right? Same thing here, this 200, we collect 40 here. 40 plus 100 is 140, plus 60 is 200. So this is the collections of that one. Does that make sense? So what we're doing here is we're converting the sales into cash, because it's not all cash sales. Yeah, so 50 in month 1. This one? Yeah, so this 50 here is 50% of last month's sales. So this is going to be the 100 here, right? Times 50%. Right? So of the 100 here, we collect 20 here, 50 here, 30 here. Of this 200, we collect 20% of it here, another 50% here, and the other 30% here. This one, of this 400 here, we collect 80 in cash, another 200 comes in a month later, and another 120 2 months later. It just goes like that. Okay. So that gives us our total cash receipts, right? The total cash receipts is the sum of all these guys, you guys, right? 80, 100, 30 is 210. 60, 260, 320, 40, 190, 120, plus the dividends we got is 340. So that's the cash receipts part of our budget. Does that make sense, you guys? We're just converting the sales into cash because we don't get all the sales are not cash. Some of it is on credit, and it takes the customers 1 to 2 months to pay us the money. So we just converted that. Okay. So that gives us the cash receipts, you guys. Now we're going to cash disbursements, which you guys said was expenses, right? Because we have to pay bills. We make money, money comes in, money also goes out. So this gives us the data for our model. It says the purchases will be 70% of sales, right? Because we're going to purchase this before we sell it. So this is kind of like a Jareer type model where we purchase the iPhone, right? If the iPhone sells for 1,000, we're paying 70% of that, right? We pay 700, we sell it for 1,000, and our gross profit will be 300, right? So we're paying 70% of the sales number is the cost to us to buy it. But we don't pay all that in cash, right? Because we have an agreement with the supplier that we can pay them over time. So 10% of that money, of the stuff we buy, we pay in cash. Another 70% we pay them a month later, and the final 20% we pay them 2 months later. So just like cash receipts, our customers pay us over time. We also pay our suppliers over time. On top of that, for the disbursement budget, we have to pay rent, wages, taxes, buy some assets, right? Some long-term assets to grow our company, pay some interest to the bank, pay some dividends to shareholders, right? Pay off some of the loan balances, and blah, 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 whatever that happens to be. This is the piece you guys will be tested on the test, is this is kind of the more challenging piece. So let's go look at this example to see how that works. So again, we start with the sales budget. Sales is driving everything. And we have our purchases, right? So how do we get the 280 here, you guys? Where did we get 280 from? In October, we purchased 280 of goods. Where's that coming from? Where is that coming from, you guys? Where is the 280? While you guys are thinking about that, I'm just going to set an alarm here for 350. Okay, so anybody got it? Okay, I'll explain it. So let's go backwards and look at our sales budget again. Remember the sales for October were 400, right? Sales is 400. So remember 400 sales October. And here we said 70% of that 400 is what it's going to cost us to buy the stuff to begin with. So we need to buy it first before we can sell it. And it costs us 70% of what we sell it for, right? So that makes sense. So 70% of 400 is 280. So 280 is 400, right? Which is the sales times 0.7, right? And same thing here, 210 is 70% of November sales, 140, 70% of December sales. Does that make sense to you guys? All we're doing is we're purchasing it in advance. Jareer has to buy the iPhones first before they can sell them to us, right? And they don't pay the same price we do. They're paying less. The difference is the markup, right? This is the markup. Okay, so far so good. Now it said we buy this stuff, right? But we don't pay cash, right? We only put 10% cash down, right? And then we pay another 70% a month later and another 20% 2 months later. So that adds up to 100%. So over time, we pay all of it. We pay 10% now, another 70% next month. So now we paid 80, and the final 20% after 2 months. So how did we get the 28 here, you guys? How did we get the 28? Yeah, so Ahmad, you're right, the collections is 210, but that's different than our purchases. So the collection, right, we sell 400 in October, but we collect some of that in cash because the customer some customers pay us cash. That's the 210, right? Not all of them pay us cash, so we get more money later. This number here relates to us paying for the stuff that we sold to the customer, which is separate, right? We're paying Apple here. In the other case, the customer's paying us. Okay. Okay, so looks good, you guys? Okay, good, good job. So 28, you guys understand how we got that one, right? We have to buy 280 of material, of products, so that we can sell them for 400. We're gonna give them 10% of that now, so we pay them 28 now. Okay, looks good. And we're gonna pay them another 70%, right, of the 280. So 196 here, you guys, is 280 times 0.7, right? We pay them 28 here, another 196 here, and the final 56, we pay them 2 months later. So the 56 is going to be 280 times 0.2. Right, so we're paying them a total, right, of 280 over a 2-month period of time, right? So let's just double check that. Make sure there's no errors here. If I take 28 plus 196 plus 56, yep, it's equal to 280. So again, just like the customers can pay us over time, we're paying our suppliers over time. And remember, this is cash. Is this going to be cash inflow or outflow, you guys? On this one for disbursements, is that cash in or cash out? On this schedule, is that positive or negative, you guys? Exactly, Ahmed. Zainab and Ahmed again. Good job, you guys. Fahad, yes, good job. Okay, so this takes care of our purchases here. Then all this stuff down here is just the miscellaneous stuff they were talking about. We pay rent of 5 every month. That's fixed. We pay wages over time. This one's varying, right? We need a separate budget for employees that we're planning to have. Maybe there's some seasonality here. We pay Uncle Sam here, right? Uncle Sam wants money. We bought some fixed assets here, right? We paid interest to the bank here, and we paid some dividends to shareholders here. So the total cash outflow is going to be the sum of all these guys, right? If we add up all of those, right, that's going to equal 213. And we add up all of these, this is going to equal 418. So now we've got our cash receipts budget and we've got our cash disbursements budget. So are you guys okay with that so far? Does that make sense? So far, so good?